Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on April 7th, 2017. Let's get right to it. Let's cut to the chase. Volatility futures continue to be bid higher throughout the course of the week. Now, for those of you that don't necessarily tune into volatility futures, well, volatility futures typically, as time progresses, have tendency to decay down. That is, the volatility future itself, well, it's a dated contract. In this particular case, what we're going to discuss first and foremost, and probably what's really most prevalent on my mind, is when you look at the volatility futures and specifically the April contract, it's only got 12 days left to live. And you know, there's a holiday coming up. You know, we're going to have Good Friday. The market's going to be closed. So a few of these 12 days, this is, full calendar days, we're going to be closed. The volatility futures at this point, they're typically in kind of descent. So if this is the volatility future at 14, it's usually, on its way down. What ultimately happens is this 12-day volatility future in 12 days eventually settles to the VIX. Okay, so the volatility futures eventually settle out to the VIX. So at the end of 12 days, there's a settlement process, and this 14 product, okay, has to ultimately merge with this 1287 product. Now, what can happen? The volatility futures can fall, or the VIX can actually move up. Neither here nor there. Again, the point that needs to be taken from here is what you're looking at over in a chart. And the reason I wanted to start with it is here's just a 5-day, 10-minute, right, on this April volatility contract. And I'll just give you a couple of points over here. Number one, we'll start here on Monday. We spike, we fall, we spike, we fall. This is typical for what the volatility future looks like. Here is that kind of wild reversal we saw ultimately on Wednesday. And it was a pretty wild reversal, and that was the S&P futures. Okay, those fell hard. The volatility futures spiked. Once again, they backed off. And for those of you that missed it, of course, last night when, the missiles started to fly over in Syria, the volatility futures spiked to 1425. That's it. The interesting area of that is on Friday, which, again, that's today, and what did the S&P futures do? Well, they closed at 2353, which was massively unchanged for the trading day. But the volatility futures, they still finished just like literally a stone's throw off of when missiles were flying over in Syria. And again, the volatility futures continually getting bid up throughout the week have really, they've been a big portion of my attention. And the reason they're a big portion of my attention, it is very, very rare. First of all, it's rare to see the April volatility futures, which are at 14, are actually cresting above the May volatility futures. So we're actually in an inverted state, which ultimately denotes that the risk in the next 12 days is beyond the risk in the next 40 days. Now, I read an article about this. They were talking about, the volatility futures have inverted. And, the only problem with the article is that it's wrong, because the article was propositioning the fact that maybe the volatility futures are flipping over because of the French election. But the French election happens outside of the 12-day window. So there goes that theory out the window. I don't know exactly how they made that mistake. And moreover, when you start to look at the volatility futures, even all the way out to June, they're actually slightly getting bid up too. They're up to 1450. But it's interesting to see, you've got this 12-day volatility future trading right there at 14. And then we've got 75 days out in time, and it's at like 1450. These two are incredibly close. Most of the time, there's about $1.50 difference between like a 12-day and a 75-day. Most of the time, it's $1.50 difference. Right here, right now, look at this. We've actually tightened up to a 50-cent differential. So what does it mean? Well, for all intents and purposes, it says risk is imminent. The only issue with this, okay, let's discount the fact, just for a moment, let's discount the fact the volatility futures inverted, okay? We'll totally discount it. You just don't see a lot of other signs like blaring risk on the screen. So if I look at the bond market, which I do frequently, the bond market has been right in around and continually testing. And I'm going to contract adjust the bond market over here. So bear with me for a second as I adjust for contract change and just hit apply, hit OK. This bond market has been testing throughout the course of this week, this 152 level. All right. Today actually shoots through it. And once again, we have a really interesting kind of proposition that happens inside of the bond market, because the bond market, if it rallies, okay, if the bond market rallies much above the 152 level, okay, it's all over but the crying for the XLF. The financials will get killed and likely take down the S&Ps along with them, okay? But I was pointing this out the other day. It feels like they just keep testing. The interesting thing about the bond market, look at it on an intraday basis over here. So, and I don't think a lot of traders necessarily caught this. In fact, I'm going to back up the time just a little bit. Instead of like a 1 minute, okay, we'll go 2 days here, 5 minutes, just so you can see what I'm talking about. All right. So coming in, of course, to Friday and Friday evening, you will see right in this neighborhood and right up here, this is when bonds took off to the upside, when missiles started to ultimately fly in Syria. So the bond market gets heated up because it gets a little nervous. You know, any military action typically taken by the U.S., markets get nervous. Clearly, it's a defensive position. You know, trade buys bonds. Why is that interesting? Well, it's not. What's interesting is the fact that the market shocked us in terms of what it did around the non-farm payrolls. The non-farm payrolls came in at, roughly speaking, half of what they were supposed to. So think about this from a risk standpoint. The market sees missiles fired. It goes to 152 and 20. The market actually sees non-farm payrolls. It gets the crap scared out of it and runs to 153 and 4 ticks. Okay? We got some big issues right now. And the big issue is simply this. The market's not even scared of war. The market right now, okay, is so fixated on interest rates. And I'm saying this because non-farm payrolls coming in soft. So the non-farm payrolls come in right around 98,000, right? They come in really soft because they're projecting, you know, about 188,000 were actually projected. They come in, again, right around like 98,000. So about half of what they were supposed to. And when I say everything's so interest rate sensitive, the reason the market reacted so much over here is like, oh, whoa, we don't necessarily think we're going to raise interest rates too quickly. Now think about the implications of that to the XLF. So the XLF over here, and I'm actually going to knock this right down, okay, in the XLF to a 1 day, 1 minute. Look at the XLF tank. This is in the pre-market. Look at it tank in the pre-market the same time the bonds rallied. So we have evidence now. Bonds rally, it's going to tank the XLF. How do you know? Because it already happened. Again, missiles flying didn't do it. The threat of the economy possibly turning a little bit south, that's more scary than war itself. It's interesting to see this because you start to recognize, right, that we very well may be in a liquidity trap, which is, I mean, again, I'm a big believer of this, but if you look at the bond market over the last couple of years, and more appropriately, let's even look at the interest rates. You look at the interest rates, there's this strong belief that interest rates are going to go up. Yeah, I'm not buying into that. This is the interest rate of the 10-year, right? And the 10-year is basically at about 2.3% right now, okay? And if you want to look back at the interest rate over like a 10-year monthly over here, you know, do you really think the interest rates are going to go back up? This is the 10-year back here. Before 08 was back at like, you know, 5.3%. What a liquidity trap basically is, all right? For all intents and purpose, it's low interest rates that remain. Why? Because you get hooked on the juice. You get hooked on low interest rates. So for the most part, the marketplace is actually looking for bad news. It'll like bad news. Why? Because it'll keep interest rates low and it'll keep feeding markets. You're like, oh, I'm hungry for more bad news so that I can actually take interest rates down and ultimately keep again, when I say hooked on the juice, it's a trade in the S&P 500. Eventually, though, a liquidity trap can actually turn against the entire marketplace. And again, lower interest rates. If these interest rates are to come down into this zone, if they really start getting below 2.3%, they start coming back down to 2%, that is really going to hurt financials and likely ultimately take down the S&Ps along with it. So obviously something to think about. Now, let's switch gears a little bit, okay? Again, you see these volatility futures, they got us perplexed. They at least have me perplexed, because anytime I've seen the volatility futures rallying like this, okay, risk has been like on the table. Like you already saw the S&Ps falling usually when the volatility is running up like this. In this particular case, we see volatility running up, and there's nothing else really confirming it other than the fact that the bonds are at a key inflection point. The XLF at 2350 is a key inflection point, and you can go on and on. Now, is there any other evidence that you see in broader markets of risk playing out? Well, you could look towards a couple of the tech stocks in here, and specifically, I'll start with Google. Okay, nothing too big in Google, a 3-day slide, neither here nor there. Okay, take a look over at like Apple over here. Is it rolling over? Come on, there's no evidence of Apple rolling over here. And I'm looking at some of the tech titans right now. I come to Microsoft. I mean, Microsoft just hit an all-time high in kind of that key reversal day on Wednesday over here. Hits an all-time high, comes off it. There's nothing going on in there whatsoever. Amazon, okay, it's a little bit more interesting. Amazon may have actually hit its, prime time key kind of reversal. For those of you that missed this week, pretty much, Amazon added more market cap than other retailers are even worth. Now think about that for a second. I saw Amazon compared to like Ralph Lauren, and Amazon actually added more market cap this week than Ralph Lauren is even worth. So it's just interesting to see this, but this could actually be a key reversal. Now, Amazon's the only one that I've had my eye on for quite some time. I do carry positions. I've got some bearish positions on inside of Amazon. At this point, though, I would have to stave off taking any additional bearish positions, because when you start looking at options that are even 21 days out, these April 28th, we're coming into earnings, which for me, it's a no-go. Like, listen, I'm not going to take a directionally biased position on the flip of a coin of, what Jeff Bezos is going to announce, inside of 3 weeks over here. It's just, that ain't going to do it for me. But it's going to be, again, critically important to watch Amazon this coming week. And you got to remember, this is going to be a shortened trading week we're coming into. Markets will be effectively closed on Good Friday, which happens to be April 14th. Now, again, watch Amazon, because earnings over here, okay, they're still 3 weeks away. So if this thing had a key reversal, it'll sink prior to the earnings announcement. Amazon comes off, it could very well take most of the Nasdaq along with it. But do you see any softening in the Nasdaq? Absolutely not. Again, the Nasdaq peaks out here midweek. Now, that's a print that's fairly amazing, at 54.81 inside of the Nasdaq. I'm not ready to call that yet the all-time high, but we're pretty close to it. And again, I'm ever the bear out there, but I'm looking for reasons right now not to be bearish, again, with those volatility futures getting bid up. Now, again, let's be a little bit more forward-looking and cruise over to the SPX in the marketplace. So why am I looking at the SPX? So I like to kind of take account of what the SPX does on a week-to-week basis. And to do that, I go over and I use ThinkBack. And what ThinkBack does is just end-of-day data. So here we are. It's Friday the 7th. I'm just going to back things up to the 2nd. All right, what was that? It's April 2nd. It's Sunday. Why? I like to look at the week as a whole. So here's April 7th with 5 days remaining. And the week was expecting about a 20, we'll just round it to $23, right? So the expected move for the week it's right there. It's right around 23 bucks. That was with the market sitting, though, at 23, roughly 63. Where did we end up on the week? Ladies and gentlemen, 23.55. Now, you're looking at this and you're thinking to yourself, okay, so we ended up inside of the expected move. Well, people, that's what's expected of us. But one of the other things that was quite entertaining in trade this week is to watch the expected move of $23, you can literally watch it be defended by the trading firms. And when I say defended, okay, just do some quick math over here. If you took these S&Ps, okay, and you looked at them at 23, okay, let's say 63, and you subtracted the expected move, which was what? 23 bucks. What do you come out with? It's a nice big round number, right? 23.40 on the button. So 23.40. 23.40 would be, if the market was going to sell off, that would kind of be the downside expected move. Let's not worry about the upside, because I want to just show you something interesting over here at 23.40. Now, if you take a look at the SPX is 23.55. Okay, the S&P futures are roughly 23.53. There's about, again, a $3 differential between these products. So why am I showing you this? Because if you looked, all right, and we're going to go over here just to a, let's cruise just to a 1 minute chart. If you look at a 1 minute chart and you were to go to the overnight session here, right in this neighborhood, and again, this is just last night, it's Thursday evening, okay? Right here is where missiles started to fly. All right, and the market caught wind of it. S&P futures are open and they sell off. But they sell off right to what level? 23, let's say it's 23, okay, roughly 37. Just round it, 23.37. You do realize that 23.37, okay, correlates precisely to the button to 23.40, equivalent to the SPX. Why did they stop at 23.37? Because they're being defended like grim death. It just means firms went out there and they sold premium in the SPX options. And when they sold premium in the SPX options, they're using the S&P futures in the overnight session to defend that position. Pretty interesting stuff, because again, you can even see more evidence of it. How often do you see almost 7,000 contracts trade in the evening, right? Okay, and again, that was the absolute bottom of the trade, and then we ultimately bounced off of it. So keep it in mind how important these expected moves are. So why am I mentioning expected moves? We stayed inside the expected move because I want you to see something kind of interesting for this next week. So now, again, we want to be very, very forward looking. Now we have the SPX roughly at 23.55. And if you look out to this next week, and this next week is kind of entertaining. Here's an option that obviously expired today. This is an option that will be a Monday expiration. Over here, of course, is a Wednesday expiration, but then we have a Thursday expiration. There is no Friday expiration because Friday, it's no go. It's Good Friday. What's interesting about it is there is a slightly elevated expected move, because last week, we saw about a $23 expected move. But last week was equivalent to 5 full trading sessions. Last week was 5 days. This week, we only have 4 days, and it's slightly elevated. So there is more implied volatility being packed in. So now we are starting to see slight bits of evidence, okay, of implied volatility starting to pick up in the SPX. The implied volatility in the SPX, though, it still doesn't explain why these volatility futures are elevated. With that, moving forward this next week, okay, keep on your game. Keep on your guard. If there's one thing that I would suggest when the volatility futures are elevated like this and we don't have a great or definitive reason, somebody sees risk. That's why they invert it. That's it, okay? Typically, when there's a volatility inversion like this, it means get under your desk, put the helmet on, we're going in. We don't see any other evidence other than the volatility future. So we're not ready to call, this is not Chicken Little over here. The sky is falling. But at this point, when I say be on your guard, you better be intimately comfortable with your positions, okay? Because when the volatility futures are elevated like this, you can get wild drops in the S&P futures, even in the overnight session. Anytime you see the volatility futures inverted like this, you get a 20, 30 point drop in the middle of the night. That's nothing, because what it really means, trading firms, people, are already hedging. They're already buying their risk metric. They're already going out there and buying the vol future. So if crap hits the fan, they're hedged. Are you? And that's one of the questions you have to think about this next coming week. Thanks everybody for joining us here at TheoTrade for the weekend update. Have a great weekend. Bye-bye.